This is the Real Estate Foundation, your show for massive action with proven results. Raise your life and your legacy with real estate.
Are you ready to take your multifamily game to the next level? Well, you need to join us October 12th, Saturday, October 12th, for our one-day multifamily foundation workshop. We're going to bring it to you live. We got a list of 15 speakers. They're going to go through the process of everything it takes to get your mind right, get the deal right, learn the terms, understand the markets, learn how to find the deals, learn how to underwrite the deals, learn how to put your team together, everything from property managers to brokers to insurance companies. Beyond that, what's the proper way to raise funds for a deal and how to close a deal and what to do after you take over a deal. So it's going to be a huge event. It's going to be awesome for you to join us. Got a great space. It's going to be here in New Jersey, in Springfield, New Jersey. Of course, it's going to be a one-day event, but we got everything packed in from 8 a.m. to 7 p.m. Right now, if you put in the code workshop, you're going to get a special discount. And again, that code is workshop. You need to go to multifamilyfoundationworkshop.com. Again, www.multifamilyfoundationworkshop.com, and go fast because we've sold a ton of tickets for this. I actually was able to get a bigger room, but that's filling up quickly as well. So again, www.multifamilyfoundationworkshop.com, put in the code workshop. There we go. Got that down. And look forward to seeing you so we can all take massive action together. Well, hello again and welcome to another edition of the Real Estate Foundation. Thanks for checking back in with us. Happy to be here with you today and super excited about today's show. Of course, if you like what you hear, please give us a 5-star rating or review or any review. You know what we like? We just want to hear from you. We want to know what you guys have to say, what you like, what you don't like. Give us better feedback so we can make this show great for you. But you are in luck because today's show is awesome. We're going to talk about stuff that we haven't covered before after almost 400 episodes is a tall tale. So that is why we're super excited to have Scott Choppin on the show. Hey, Scott, how are you?
I'm doing good, Jason. It's good to meet you.
Good to meet you as well. And Scott is the founder of Urban Pacific Group of Companies, a Long Beach, California-based real estate development company founded in 2000 that focuses exclusively on urban infill and affordable housing communities throughout California and the Western U.S. Over the last 18 years, the company has developed nearly 1,700 units of unique-to-market urban housing communities throughout the Western United States. And presently, Urban Pacific has created a new housing innovation called UTH, which provides middle-income, multi-generational housing to urban families by producing market-superior yields on invested equity. Historically, Urban Pacific's UTH projects have delivered, and get this, 29% IRR yields on equity. Well, Scott, this is awesome. And so we got a lot to dive in here for, but talk to us about, 2000, right? So a lot happening, especially out there in California at that time. What drew you to real estate, and what was the first step you got into here to form Urban Pacific Group?
Yeah, no, I appreciate that. Great question. So I actually have a family background in real estate development. So my uncle Mike and my dad Kerry were both in the business. Each ran their own companies, one in commercial real estate development, and then my dad was almost exclusively an apartment development company. And so I, got the unique advantage of growing up in the business of, real estate development, which is, a little obscure, right? It's not your mainstream career choice. So I basically built over, the early years of my career, both in my choice of school, major, and then going into my early career choices of really intending to build my knowledge of how to be a real estate developer. So I went out and worked for other companies for, a little over 5 years. And then in 2000, what happened, the company I was with at the time had done some research using a company called Robert Charles Lesser and Company, pretty well-known national market study firm. And a guy there at the time, Bob Gardner, was very bullish on urban infill, basically building new construction apartment assets in the city center or city fabric, right? Think of, not necessarily, pure downtown, but anywhere that was already urbanized. And we would find sites and infill, apartments into those neighborhoods. And the company I was with at the time, the principals were very sophisticated, great developers, but this just wasn't their flavor, let's put it this way.
Hmm.
And I was like, man, I like at the time my age, I was like, this is the thing. Like, we need to go pursue this. And so that was really the the genesis of the idea of pursuing on my own urban infill apartment. We have done for sale, but really we're an apartment development company, and that's been our our stance up to today, which is we want to be in urban locations developing apartment assets.
Sure. And so before we jump into the development, I have to talk about the family dynamic, right? So
Mhm.
lots of times when people are growing up, the kids run as far as they can from everything that their parents are doing. But
Yeah.
you dive all in. What was it that really stood out to you about development? What was it that drew you to it?
Actually, the way you spoke it is right on the money. In fact, I think this is probably true of all kids. You want to do whatever is the opposite of what your parents did, right?
Yeah.
Run the other way, as you put it. And so for a period of time, that was just not something that I was interested in. But really, two things really, brought forth for me how real estate development could be a career. So first was that out of high school I wasn't intending to go to college immediately, or at least I didn't have a good plan, so I went and worked in the trades. I was an electrician for a couple of years, and what I noticed at the time, and where we were living in Long Beach, in fact, there was a lot of apartment new construction. This is in the mid 80s, just booming apartments. And what I remember is working on the job sites. And, electricians are actually probably some of the cleanest trades. You're not getting overly dirty. It takes, most knowledge. But the developers would show up on the job site, Jason, and I would watch them, in between working. And because I had the background in it and watched what they were doing, I was like, I want to be that guy. I want to, for lack of a better way to put it, drive a nice car, show up, look at a project under construction, point some stuff out, make some decisions. That's how I interpreted it, at least at the time, at, all of, 18 and 19 years old, mind you. And then, interestingly enough, I happened to, I'm a voracious reader. And at the time, in fact, it's still around. I think it's still being published, but there's a book called, How to Make $1 Million, Investing in Real Estate on the Weekends.
Hmm.
You've probably even seen it, right? It's one of
Yeah.
those, age-old books. And I read through that, and it really finally dawned on me. I go, okay, I see what my dad and my uncle are doing. I saw these guys in the field, right? Seeing, how they are and what they did. And then the financial, mechanisms were, really shown to me in this book. Now, that book was about investing in existing apartment assets and not new construction or development. But I could see the parallels. And so from that point on, which I think I was 18 years old, as I recall, everything I did from that point on was intended to build my knowledge of how to be a real estate developer. School major, school choice, early career choices were all aligned to do that, with the end result I knew I would be, going out on my own as an entrepreneur.
Sure. And so you dive into your career path, right? And you start working for that company. You speak about the urban infill, and the company wasn't best aligned for it, but you saw it. What was it that jumped out to you? You said, well, this is it. This is the niche.
So when I left the former Pacific, I was 32, a Gen Xer. Um, I to me, it appeared as a highly advantageous living environment to be in a urban location, close to where you worked. You didn't get on the freeway, and combine that with some really cool housing choices. Think, old building, brick lofts, really cool, industrial, neo-industrial, loft space in downtown LA or downtown Long Beach. And to me, I was like, man, I would live there. Now, at the time, I happened to be newly married, and first my oldest son was born, so we weren't going to necessarily make that choice. But I was like, I could see how other people like me in my generation, who didn't necessarily have family and were maybe more mobile and could live that lifestyle, it would be highly appealing. So it was a real personal, almost gut level, visceral reaction of, one, the spaces are super cool, right? I mean,
Yeah.
it's, sandblasted red brick and, wood trusses in the roof, bow truss. I mean, just cool stuff. And that just absolutely appealed to me. And I recognized that other people in my generation at the time who were still young enough to live in that environment would be attracted to that.
Do you remember what that first project entailed? Like what drew you to the first project you did when you first started Urban Pacific?
So, yeah, great question. So at the time when we formed the company in 2000 in downtown LA, a ordinance had been passed recently called the Adaptive Reuse Ordinance. And that ordinance basically was, City of LA is a big bureaucracy, but this is a very entrepreneurial, cutting edge ordinance that basically said if you had a historic building or a pre-1973 permitted building, you could convert almost any building that was in these, geographic areas into residential housing. So old industrial buildings, old high-rise office buildings that had been empty, like literally empty buildings in downtown LA for decades. The city said, if these buildings qualify and are in these geographic locations, then we will give you not quite a carte blanche on the zoning and the building code, but a huge amount of relief related to zoning, density, parking, particularly stuff about fire egress, fire life safety for the fire department, and seismic. You still had to do seismic, but it was to a FEMA code and not to the actual California building code, which would have made the buildings infeasible to build in that or retrofit that way because it would have been too expensive. And so we basically we ended up doing 4 of those projects, all, 100 to 200,000 square foot office buildings built in, between 1895 and, let's say 1920. Great architecture, Beaux Arts, beautiful exterior, really, high quality marble exteriors and, statues and, stuff that you just couldn't build anymore. And that fit in that, that ethic of we want the cool building and the cool space.
Yeah.
Happened to be in downtown LA, which was, semi rough at the time, but it was very early in that new era of urban living. And we were certainly a few years ahead of it. So this is 2000, 2001. By the time 2004 rolled around, the market had taken off, and there's all kinds of people. It was that fast that everybody picked up, or at least developers got the idea to do that.
Wait, now, and going forward to today, how does the strategy change? What is the core focus today?
So the core focus always has been and is now that we want to be building new assets in urban locations. So in other words, we're not going to go out in the far perimeter of, the LA basin into, Riverside County, go build, greenfield sites, right? Like never developed sites. We want to find neighborhoods that are close in to transit, jobs, social networks. So think if you're a family, you have kids in school and your family's close by, those kind of things. And we have never left that stance or call that ethic, the standard of how we, operate in the marketplace. And if anything, we were early and the market came to us in 2004, 2005, recession came, everything stopped cold. And then, picking back up in, 2010, 2011, now by that point, post-recession, now we have millennials and Gen Z coming into their life cycle where they rent and move out of the house or want, move to an urban location for a job. Maybe they work tech and they want to move into, downtown San Francisco. Now those generations, those demographics were even more bullish on the urban lifestyle, right? I mean, Gen X sort of had its time, then grew out of that life cycle, got kids, needed a, house and, a driveway and all the normal stuff that you have when you have a family. And Gen Z millennial has just taken that mantle and run with it. In fact, they're more purely wanting urban living than, any generations we've ever seen.
So for development, it's part art, right? Along with, of course, making a project that's going to sustain and be beneficial. So hey, talk to us about some of the steps to underwrite a project of this magnitude where you're just basically looking at a canvas and being able to find the highest and best use.
Right. Yeah, that's a great question. And thinking of it as a canvas is perfectly right. So the way I think of it, differentiating between, a value add investor, value add sponsor, and then those investors or sponsors in new development, really in 3 buckets is the way I think of it, Jason. So the first bucket is just your standard multifamily underwriting, the same as you guys do when you acquire existing assets, we do on new construction. So we have to assess, what are market rents, what's the purchase price? Is it coherent with the marketplace? We got to underwrite operating expenses. We got to, boost the NOI as much as we can, underwrite our construction loan, underwrite our permanent loan, right? So all those are very similar in how like the value add guys do it. So that's bucket number one. Bucket number two is the development space, right? And I'll just, I'll say this and then I'll come back to it. And then the third one is also what you guys do in value add, or anybody does, which is that we're intending to improve an asset so that it can be more valuable at the end of the day, at the end of the investment cycle or whatever period of time that you've agreed with your investors to invest. And then we want to maximize the sale value, right? We want to sell at a profit, right? So bucket one and bucket two are the exact same for you guys as it is for us. Okay, now it's the middle bucket that is the differentiator, right? And where the real contrast is. And so in bucket two, you have things such as, how to buy land, right? How to underwrite and assess zoning, how to design a building from scratch, right? Because, in value add, you go assess a site and a community, and it's got a mix of 1, 2s, and 3s. They have trailing 12 historical records of rents, what operating expenses are. We still have to make those same assessments, except now we're creating more from whole fabric, right? Like blank canvas, as you put it. And then we're adding additional variables that you don't deal with, at least in the same way. So now we have to have a whole team of architects, civil engineers, mechanical, electrical, plumbing engineers, right? Those kind of guys that design the whole building from nothing. Then you have to, figure out how to build it cost effectively, right? And then, then that's sort of the end of it for the most part. And then you get back into the normal, underwriting, upfront and underwriting the sale. So those are the high level stuff, and we can certainly get into the details of any of those, as you want. I would say that probably the two biggest, like the highest differentiated items in that second bucket are the zoning and the design, and then the build, right? So the build costs. Now in value add, obviously you're, changing, paint, carpet, countertops, cabinets. You try not to get into systems if you can help it, maybe a little bit. You certainly try to never touch structural in a value add asset. You don't want to unless you know what you're doing in that structural domain. So, we're much more intensive in the build cycle, and we need higher performing subcontractors, GCs, if you use that. And then on the design side, you basically, the way I think of it is, when we look for a site, we start first with the neighborhoods that we want to be in. So we've identified, let's say 20 or 25 neighborhoods around Southern California. That would be LA County and Orange County is our predominant focus right now. And then we're looking for certain size site, right? Piece of land. And then we have to look at it and we go, okay, how many units can we fit there? What is it going to cost to build? What are the rents? What are the operating expenses? And then we produce a pro forma that says, yes, this thing's viable. It produces sufficient return to attract capital, maybe market superior to other investments, is how we want to structure it. But inside of that, we're picking the unit mix. We're picking the unit type. And that's from an assessment of the market and more in the context of identifying gaps. So when you go buy 200 units in Dallas that's existing, you're assessing it in the marketplace, but you can't change it. I mean, maybe you could combine 2 1s into a 2-bedroom, but that's unusual, right? That would be rare. So you're sort of operating from the already given unit mix and trying to assess, is this a good investment in the context of the market? And then make your choice based on that and other variables. For us, we can actually go into a marketplace and create that mix. We actually produce a unit mix that we prefer, that says we're meeting a gap on the marketplace. We've identified a space that's not competed for. So as an example, UTH model that you described earlier in your intro is a 3-story townhouse rental unit. It's got a garage on the ground floor, 2-car direct access garage, 3 levels of living. But here's the key. It's a 5-bedroom, 4-bath apartment unit. And we do that purposely because we've identified in the marketplace that middle income working families in Southern California do not have a new construction model that fits their lifestyle. So if you're a family that lives multi-generationally, or culturally you come from a place where families stay together in family groups, and you go into the marketplace in Southern California, what you're going to find is a predominance of ones, twos, and threes, with really the highest level being twos. And if you have a family of 6 or 8 or 10 people, well, now your only choice is I got to go rent a house, which is fine. I mean, that's, in fact, we say that's our main competition, but that's generally going to be much more expensive. I always say, Jason, our families would always prefer to rent a house if they could. Who doesn't want a backyard and a driveway and a front yard, right? That's the, the American dream. But then we get into affordability questions when that house is $5,000 a month to rent. And then we can supply a virtually similar house that's maybe a little smaller, still has the bedroom, still has the garage, and serve that at $3,250. Right, we can be very much below the comparable rental home marketplace with zero competition in the apartment marketplace, like actual, projects were built on purpose to rent, right? And so those are the that would be an example of a niche or an uncommon offer into a gap or a space in the marketplace that's really not being contested or competed for. And those are the kind of places we want to be.
And so when you're looking at this, and you talked about finding the land, at what point does the zoning or the land use come in? Are you just trying to find sites where you have or the use in place or some comparable use, or is that always built in the time and the money to go there and convert for use?
It goes both ways, but I'll give a little bit of refinement to that. So you can either find a site that's already got zoning in place that works for our product, right? We're like 25 to the acre. That's our density. We look for sites that fit that at what we call a by right zoning. In other words, we don't have to change the zoning. There's no site plan review, nothing to do at the political level, city council, which is very common for developers. We do that in the UTH program. But historically, if you look at our track record, we've actually tied up and what we call entitled land, which is mean we rezone, we design a site plan review, maybe we do in California general plan amendment. So, major entitlement, changes to zoning and planning that take a lot of time. Okay, so the first one is UTH by right, and we do that because we can operate and move through the projects quickly. And we also virtually eliminate the risk of discretionary going to city council and they say no, right? Which happens in the business, particularly in California. The other side of it is that you find a piece of ground and you do want to change the zoning, you do want to re-entitle it. In that case, we would always buy the land in a long-term escrow that gives sufficient time for us to move through that political process comfortably, or we just don't close, right? And so if a seller says to me, look, it needs a zone change and you got 60 days to close, I'm like, no thanks. It's just not a risk we're willing to take. And most savvy, sophisticated developers don't take that risk. Some do when they really know the city, they really know the politics, maybe they know the market, maybe they're, have, high identity locally, politically. There's always those stories, right? But that's, one-off or rare versus, if we went up to Northern California and wanted to rezone a site in, I don't know, pick any city in the Bay Area, San Francisco, you're looking at a really tough, long road. I mean, actually, San Francisco is a great example. On average, projects are taking between, 5 and 8 years to entitle.
Wow.
Meaning you either have to buy the land and sit on it for 5 years, or you get, 5-year escrow period, which does happen. It's not particularly common, but those are the kind of stories where we just go, hey, UTH, we want it to be simple, low cost land, simple, like no zoning by right. We have a simple build model. So at multiple points in our business plan for UTH, we've moved to simplify the things that we choose to do. Like we don't do entitlements, we only do by right. And what that all adds up to, one of the ways we can produce that internal rate of return is that we're shortening the time periods of our investments from, acquisition of land, and, closing on equity in your construction loan to the time that we rent and sell it is compacted. It's made more efficient. And that's a key part of why UTH works.
What is an ideal timeline for a project for parameter wise, just for concept, just so people can understand from, of
Yeah.
course, find the land, closing on the land, getting basically plans in place, shoveling ground, putting this up, stabilizing with rent and selling it.
Yeah. It would depend on the size, but for a small project, let's say, up to, 30 units, you could probably get that done in 2 to 3 years.
Hmm.
If you're 100, 200, 300 units, you're probably talking 3 to 5 years.
And when you're doing this, what is a structure? You do this, bringing in an outside investment. How do you structure this with investors so they understand this model? What kind of investor is
Yeah.
interested in this kind of model?
Well, I think it's the exact same investors that you guys see in the value add space, high net worth individuals, small and mid-sized family offices. On bigger deals, you would have institutional capital sources, the Prudentials of the world and the Goldman Sachs and the Colony Partners and the Weyerhaeuser, different names like that. So it's the same, menu choice of potential investors. And then our structures are, very much similar to what you guys see as well. So typically how we underwrite deals, we'll say for the construction period, we'll look at 75% of the capital stack, meaning the cost to build is a debt, construction loan, 25% equity, right? And then in the equity, you're going to typically see your same co-invest structure with LP, GP, so 90-10 on the co-invest. 95-5, if it's a aggressive investor or a really, really good market. And then the return characteristics, I think at least as I am talking to people more recently, on value add deals that could actually make sense. Most investors are looking for mid to high teens on an IRR basis for a value add deal. Development deals should produce a higher IRR because there is a higher risk, right? We have to build a new building that does not have any tenants, and then we have to, speculatively build it and find tenants and lease it up and get it stabilized. So there's the additional time risk and it's longer period, and then you're starting from zero as far as any income. That's why we see a lot of investors that go, it's too expensive to buy in certain markets for value add, like what we talked about at the beginning of the our conversation today. And so they start looking around for development deals because they go, wow, I could get a 22, 25, 30% IRR. That's great. And then you sit down and you talk to them about the risk profile. And, the one that always gets me is they go, okay, so you mean I have to have a empty piece of land or an empty building for 2 or 3 years until I get some tenants? And I go, yep, that's, development. I don't mean to be casual or, punishing about my comment, but that's a reality of development versus, you buy value add and you can at least say, I've got trailing 12. I know what this deal looks like. Maybe it's worst case if you're, buying a distressed asset. And then I think there's an easier pathway to underwriting rent increases or savings on operating expenses, either one to increase NOI. And so it's a simpler, maybe less risky story or narrative about how I go from here to the end of the deal and make money. And so that's why you see more investors in that space. And no, no editorial about that choice. I go, look, that's the choice you need to make as an investor. You need to make the right choice for you. I just say, from our standpoint of why we would tell investors there's advantages to new construction multifamily, is that you're able to differentiate versus value add on a long-term basis. So as an example, when you invest equity in a new development deal, you end up the day, if you're on a long-term hold, with a brand new asset. Right? Perfectly brand new. And it's got all the new bells and whistles. So you got air conditioning, you got parking, you got a dishwasher. That's already built into the design and your investment from day one. Two is that we see location choice as an option, right? When you go buy, let's say you got to buy a 200 plus unit deal in the Dallas Metroplex, there's only going to be so many deals that are available at any one time that fit that. And then you sort of have to assess the neighborhoods from, let's say there's 5 deals that are like that. And you go, okay, I don't like it in the neighborhoods. Well, then, you may choose not to do a deal. We go the other way around, which is like we have our identified neighborhoods. For us, northern urban Orange County is a great, space for us. Blue collar neighborhoods. very highly sought after market, good brand recognition, for the most part, good schools. And then we can go in there. We don't always find land in those markets, but more often than not, we are able over time to find land that's the size and price that we need to make sense to be in that location. And then the last one is just like what I described earlier, is you build the unit mix and the unit style that you choose, that's identifying and addressing a gap on the marketplace versus value add. If the building's all 2 bedrooms and it's in the right neighborhood and the right price, well, you're stuck in essence with the 2 bedrooms unless you do something radical and change unit mix, which does happen occasionally. So those are the advantages that we see, sort of contrasting value add with new construction.
So identifying location, being able to make your own style, and of course ending up with a new asset are awesome hedges to risk. How do you prepare for you have a 2 to 5 year horizon where just a multitude of things can change? How do you
Right.
hedge your risk over that horizon of timeline?
Great question. In fact, on my weekly email, I just I wrote a fairly lengthy article about, as an investor, how to prepare for a recession. So it's going to come out 3 parts.
Huh.
In this instance, we're doing a couple things. So we're changing our strategy of how we raise capital. So in the last, let's say, since 2011, 2012, we've really raised capital to merchant build projects, which means we build it, we rent it, and then we sell it. And then we produce our profits, pay back our investors, pay back the loan, and then we're out, right?
Yeah, sure.
Now what we're doing is we're saying, look, we are anticipating a recession at some period of time. Is it 18 months, 24 months? Could it be 3 or 4 years? We know what's out there, right? We're at the longest expansion of economic activity in U.S. history. Yield curve is inverted. There's different signals. There's a lot of noise. So it's not clear that there's recession coming, but we're due. And so we just say, look, we're vigilant about it. We're not in a bad mood. Like, we're not going to just get out of the market. But what we do is be prudent and prepare and be vigilant. So how that shows up for us is that we're now raising long-term hold equity, think 7 to 10 years, and then we still choose the right locations and the right product type, which this UTH model is serving multi-generational blue-collar working families in blue-collar neighborhoods throughout the urbanized area of, say, Southern California, right? What we like about that tenant base and why we see it as a hedge against the recession is that these families are very sticky. Okay, so if you've got your millennial and Gen Z, which is the predominance of all the new apartments being developed, all the big guys are doing the studio and 1 bedroom product, right?
Yeah.
Urban infill, maybe mid to high density, and the appropriate choice, given that's a huge demographic, right? Gen Z, millennial combined are the largest cohort demographically in U.S. history. Kids, baby boomers, they're at the right life cycle to come out of the house and rent, maybe early jobs after college. But what we assess about that demographic, and there's nothing wrong with this, like, this is just, we're assessing how people will act for themselves normally and appropriately. And in a recession, a millennial correctly will say, hey, look, I just got a job in Austin, I'm out, right? And I joke internally with my staff, I go, look, millennials and Gen Z perfectly appropriately can be gone to Austin tomorrow. Like no kidding, right? And so if you look at the entirety of the majority of the development marketplace, they're serving that demographic. And I go, okay, right now it's good. It's still, rents are going up in Southern California, but eventually we're going to hit the recession, and then the dynamic changes. And I see mobility in millennial and Gen Z, again, perfectly appropriate, as a factor for how those buildings do in the long run. And I think there's going to be pain there, right? If you're the last 1 or 2 projects into a marketplace and you're renting right when the recession hits, you're going to have to drop your rents. That's just the normal strategy, maybe increase recessions. And then everybody else is going to do the same. So now everybody's just bashing each other to, race to the bottom, right, for rents. And what I say is all the big guys, the Trammell Crows, the Holland Partners, the Amleys of the world, those guys can sustain a lot of lower rents for a long period of time. It's corporate money. They're not individual entrepreneurial developers or investors, right? And they're going to eat everybody's lunch. They can drop rents more than everybody else. We created UTH, in fact, because we made the assessment when we sold the last group of buildings that were in that unit mix for millennial Gen Z, that we said everybody's piling into that marketplace,
Yeah.
again, appropriately, because that's where the demographic growth is. But we also are just style, as we said, we don't want to be there. We want to be contrarian. Where is everybody else not? And where is everybody else not that has the correct demand characteristics, right? And that's why we landed on this blue collar, working class, multi-generational family. And when we started to look at it, we said, man, there's nobody serving those families with new construction product.
What is the number one reason why developments fail?
So back to the things I talked about before. So failure would be the entitlement process is not successful. So let's say you bought land and you made a bet that the political process would go in your way, right, and not against you, and people like lose because politicians are politicians, and they're not I don't want to say they're not logical people. This is not to insult particular individuals, but the political process is fraught with peril, right? It is that way. Second is the build process that I mentioned before, particularly people who are new in the business, don't have great, GC or subcontractor networks. Costs go against them and costs increase. And now all of a sudden the deal doesn't work anymore, right? And then the third big one is just the value and rents when the project's done and renting up and getting ready to sell. And so this is why we change our strategy on equity, because we say, hey, if we've got a 10-year hold, I can be relatively comfortable that if recession is between 2 and 5 years from today, then 10 years, I'm going to have gone through the recession and come out the other end. Now, we're not bulletproof in the recession. Like, I'm not sitting here saying, look, we're never worried about it. But what I say is our UTH model, these blue collar families are very stable. They stick around. In fact, I call them sticky because they have social networks, kids in school, their church is close by, their families live adjacent. Maybe they're from there and then their job is, close by. They're not super commuters generally, these particular demographics that we serve. And so opposite of the millennial, they're going to stay, and they're going to basically, they may, kids may come home and live with them, right? Maybe grandma moves in with them to, share costs and share income amongst the family group. And we see that as a very stable, demographic. And then we're serving them with the right unit type, right? That keeps them, feeling good about it. And plus there's an economic sharing model, right? It's more bedrooms, more people in a family group can live and share income, right, and costs. And so we see that as a stable income generator through a recession, right, because they're sticky, they stay close, their jobs are close by, they don't leave town. We underwrite, at the market, but we're not trending rents in our model out 2-3 years. We underwrite to today's rents. And then we're an uncommon offer, so we don't have a lot of other people competing to build 5-bedroom units, next door to us. So it's rare. And then the main thing in that case is what we have to worry about so we raise capital, we rent the units up or build it, we rent the units up, we're holding it. And then the main thing we have to worry about, if we assume incomes and rents are stable, or let's say rents are stable, then we worry about the value decrease in a recession, right? Maybe interest rates go up, values go down, although we're in an incredibly low interest rate environment right now. But let's just say values drop, right? We don't have to sell. This is the beauty of it. We're not forced to sell because equity says, hey, I want to be out in 3 years, and then the recession's in 3 years. Oh boy, now I got to sell this asset at the worst possible time. And, so we say, of course, as anybody would, we prefer not to do that. So let's have a 10-year time period on it. And then we just need to adjust how we underwrite perm loans in that value shift time during the recession. But otherwise our incomes our rents are stable.
So Scott, this has been awesome. Let's jump over to the snap section question, okay?
Sure.
What's the best piece of advice you've ever been given?
So I study with a group called the AJI Network up in the Bay Area, and they are big proponents of acquisition of strategic knowledge. And so it would be continuous, aggressive, competitive learning is the most important thing I do and the networks I have around me, and what I would advise anyone and everyone to do. Think about it today. We're in the most highly technologically advanced, most competitive global marketplace in human history. We need to orient our learning around, computer-based, learning with powerful networks to acquire strategic knowledge so we can compete effectively in this new era of, technology.
What's your real estate superpower?
Real estate superpower. So the best part of what I do is in that early acquisition, like think of it creating the deal, right? So I see a piece of land, I go, what goes there? What problems do I anticipate? And I have a background, I'm not professional, but I've always been a musician my entire life. And I've just made my own music. I don't call myself a songwriter or anything like that. But the creation process to me is almost exactly a mirror of what I do in the early parts of the real estate development deal. I'm looking at all the different pieces and I put them together in unique ways to create value. And so that creation in the real estate development space is, how I'd answer that question.
What is a lesson learned on a project that's, regardless if it was a hard lesson, has definitely propelled you forward?
Yeah, no, great question. So what happens to people who are early in their real estate investment or development careers is they always assume the most positive case for a deal. Like everything's going to go right, costs won't go up, rents won't go down, operating expenses are going to stay stable. And so the lessons I always bring to our deals right now is we just underwrite the reality, right? There's no point in sort of pretending that things aren't going to be different than what we might, judge or make the assessment. In fact, my joke is when I was young in my career, every deal was possible, Jason. There's no deal that I saw that couldn't be done.
Mm-hmm.
And now I'm the opposite. I'm like, there's most deals won't make it, and I'm just fine with that. And then occasionally one sort of rises out of the soup and, meets all the tests and, all the stuff I throw out to break it. And when that deal comes along, you go, that's the right deal.
That's awesome. What's your greatest tip for success?
Not to repeat myself, but I think that's the continuous competitive learning. I think that's so applicable to any place. And real estate development is a very obscure business with zoning and putting the deals together. So it's not mainstream. So if you were to, somebody wanted to start a career on that, that learning process would be highly valuable, but then it doesn't stop. Right? You got to keep going. You got to see what's new, how you can use new tools, new technologies to remain competitive. And let's admit, the real estate business is not the most, forward looking on, use of technology. We're sort of like old school, ancient technologies still, are fairly commonplace. So I'm a big proponent of, the learning and then, using new technologies to advance and to be more competitive than everybody around us who we, of course, compete with, day in, day out.
Well, Scott, I've really enjoyed this. I've learned a ton. This has been great chatting. For listeners, what's the best way to find out more about you, find out more about Urban Pacific Group, and connect?
Yeah, I appreciate that. So I would encourage everybody just to go to our website, which is www.urbanpacific.com. And take a look there. We've got a lot of investor education articles, blog posts, about, investing in new construction deals and just, being a good investor. There's deals that we're raising capital on now there. And then obviously, a lot of background about us. But most particularly, I would encourage people to go look at our blog. I write a weekly email blast that we also post on our blog which just basically is a collection, curation of all the articles I read, which I'm reading, daily as probably you are. And so I curate those and, I'll look for new trends, new ideas, market shifts, market drift. What's the latest market assessment about, multifamily, and I share that out into the internet domain. Sorry. And then also, put it out on our social media channels. So we're on Twitter, Instagram, Facebook, and LinkedIn. If you just search for my name, Scott Choppin, you'll find me, pretty much in all those places, and you'll see, the consistency of the curated information that we put out about, being an effective real estate operator and investor.
Oh, that's awesome. Well, Scott, thanks so much for coming on the show today. Really appreciate your time.
Yeah. Thanks, Jason. Enjoyed it. Appreciate it.
Awesome. And to you all listeners out there, again, thank you for checking out the show. Talk to you shortly.